Hello friends, last week in my video, we analyzed the data and found that the bulls were lacking in buying momentum. They were buying half-heartedly, whether it was the MWPL or whether it was a retail risk appetite data that we analyzed. And we saw the impetus in charts and a whole lot of other data, which seemed to indicate that buying was half-hearted. Plus, the most important aspect that people are not able to grasp even now as we speak in this video is the cost of funds concept. Remember the two charts of the Nifty and the Bank Nifty that I shared with you, wherein I showed you that after 2021 October, in 39 months, the Nifty and the Bank Nifty have not gained absolute price, which is even covering the cost of carry, rollover cost. Forget about the cost of funds, the interest cost. If you were to calculate that, bulls are in a problem. Now, if you've been paying attention to what I told you about Dick Stoken's work, he is very clear. If the price of any asset is rising slower than the cost of funds for at least 2 quarters in a row, the price of that asset can fall any time. Do remember that economists tell us that if there is a slowdown in the GDP growth rate and the GDP growth rate falls for 2 consecutive quarters into negative, we are deemed to be in a recession. The same concept applies into your investments. Now, it is because of this that the market is falling, and when will the market reverse? We'll come to that also. Friends, before I proceed with this video, I want to thank you from the bottom of my heart for the support that you have shown me as my online family for the small problem that we had online. Some miscreants unhappy with the amount of free data that I share with you, the raw tick-by-tick files on my free Telegram account, or procyclicality and procyclical hysteresis hypothesis. And what's that? Many people say, because they don't understand it. And now that you understand because of what I explained to you in my videos and the procyclicality tutorials, obviously some people are displeased. They flagged off my content and had my accounts suspended. Luckily, a lot of you responded immediately and got my Twitter and Facebook accounts on track almost within a couple of hours. But these strikes may occur again. So do stay connected with me on all, at least as many social media accounts that I have. The contact coordinates come at the fag end of this video and in the pinned comment below, so that you don't get cut off completely with me. We will always attempt to keep the line of communication between ourselves open, come what may. Coming up on your screen is the weekly market roundup window, and it tells you that for a change, it was the Bank Nifty which led the way down. Do remember, this is again something that not many people are telling you in the public domain. The weightage of the banking and financial sector stocks is at 34.60%. It's something I have been rubbing into you every video. Now, this huge weightage in banking has dragged the Nifty 50 also down, which is again one of the reasons, in addition to Dick Stoken's cost of fund theory, that is tearing the markets downwards. Now, the US dollar index, the DXY, went up almost within a kissing distance of 110. Now, that means that emerging market, stock markets, financial markets, their currencies are going to be hauled over coals. And that is precisely what happened. Look at the way the USD INR, which is the United States dollar versus the Indian rupee, appreciated. We are now closing firmly above 86, which means the rupee is at an all-time low versus the dollar. Now, in spite of the fact that the dollar was strong, bullion stayed higher, which is something that I forecast in my videos. And the list of all the videos that I want you to see is in the pinned comment below and in the description below this video. Please apprise yourself with these important videos. So, in spite of a strong dollar, bullion is rising, which means safe haven buying and fear-based buying is back in the market. Crude oil and natural gas went up on seasonal factors. Do remember, I've been telling you, natural gas is the by default fuel of choice for indoor heating in winter in the Western Hemisphere. Indian 10-year benchmark bond yields remained under pressure, which means bond prices were marginally higher. Had it not been for that, the Bank Nifty would have taken a bigger hit. NSE market capitalization fell a whopping almost 4.5% in a week. Now, that doesn't happen too often. That tells you that the selling was fairly broad-based. Market-wide positions limit went up a tad, but the US market headline indices fell across the board, and that created the headwinds for our markets. Friends, I now come to the ratio chart and look at what's happened. I've been telling you since many months that I want this ratio between the Bank Nifty divided by the Nifty. Now, you can get this ratio chart for any securities that you want to compare by typing Bank Nifty / or divide by Nifty in your trading view script name kind of space and hit enter. Now, we had a attempted breakout a couple of weeks ago. Look at the downward sloping trend line. We attempted a breakout. Breakout proved to be elusive and abortive. And once the bulls surrendered in the week prior and last week, we basically had clear indications that this market was walking on very, very thin ice. Friends, I can't point out this window too often enough. This is the crux of why the market is falling. Now, when 34.6% of the weighted stocks in the entire index in the Nifty 50 are falling, how would you expect the broader based index to stay high? Do remember that banking and financial sector stocks are not only the highest weighted stocks, but their weightage is more than the three next sectoral weightages in the Nifty itself. That's huge. This is the swing sector. And add to that Dick's Token's theory about cost of funds, which nobody unfortunately is telling us, you have a problem on your hands. Friends, I now start with our in-house indicators. I start with MWPL. There's a special tutorial for you to watch on MWPL, ticket size per trade and the churn ratio. Please do make it a point to apprise yourself with this completely super critical and mind-blowing do-it-yourself kind of a simple indicator which you can plot at home. Now look at the MWPL data. After a fortnight after expiry, what you are seeing is the second week after expiry, I beg your pardon, what you are seeing is 33.64% MWPL reading. Obviously, below the commensurate week in the prior month and definitely a whole lot below a whole lot of months prior. Now, that tells you that retail bulls are kind of buying stocks, but hey, they still remained half-hearted. Would you blame them? They've been paying mark-to-market margins ever since the market has been falling very, very sharply every month after 4th of June 2024. I've shared this chart before, but take a look at it for refresher value again. Now, it's all right for a non-trader to be very bullish. But what happens to a guy who's holding long positions and in leveraged futures? You not only have to pay mark-to-market losses, and it cannot be paid with collateral, it has to be paid by cash. You also have to arrange it before the trading session opens the next day. Secondly, peak margins have to be paid within half an hour or there are stiff penalties. ELMs, extreme loss margins, have to be paid immediately or the broker penalizes you or you even risk your trade being squared up. Now, these are aspects that a real world trader will tell you. Now, this is unfortunately why we are lacking in a coordinated a place where real world traders can actually come together and share ideas. Friends, the next indicator is the stock and index futures turnover. This chart is spanning 20 weeks. And this is of 3 concurrent expiries. So it is January, February, March. Turnover actually went up, which means the retail not only was participating in the fall, but they seem to be kind of prepared for it as well. That's a good sign. Now friends, the advanced decline ratio, what you are seeing is the Nifty having lost a substantial amount of 2.39% decline logged last week, but the advanced decline ratio fell to almost half. From 1.51 in the prior week, it fell to 0.76, which means for every 100 losing stocks, there were only 76 gaining stocks. Hey guys, this is not good. After the price itself, the advanced decline indicator is the most leading indicator and it's not painting any pretty picture. Now let's take a look at the prompt futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Exactly like the options premium, basis in the futures erodes over time. But all other things remaining constant, high basis indicates high optimism and vice versa. And the most important thing here, if basis inverts, which means the futures trade at a discount to cash, that means short selling pressure has started. Now, take a look at how the basis has contracted sharply in the Bank Nifty and kind of somewhat slower in the Nifty 50. But the time to expiry and confidence levels have eroded the optimism of the bull. Now friends, I come to our in-house indicator and you've been trusting it for almost 4 years now. It stood the test of time, the impetus indicator. Look at what's happening. The Bank Nifty impetus reading has jumped and the Nifty 50 impetus reading has also gone up. What does it tell you? It tells you that bears came to life and started forced selling, short selling in the indices, more so with the banking space. Do remember, I have been warning you that cost of funds will go up, interest rate sensitives, which is banks, NBFCs, heavily debt-laden companies that depend on EMIs to have sales of their products will suffer the most. And here you have it, the Bank Nifty is now getting beaten down and on high impetus. Now this impetus tells you that force was focused on sales. Ideally speaking, the price should go up with rising impetus for a sustainable bull market, or if prices are falling, the impetus should fall, which means fall was on low selling pressure. But here we need to watch this. I put up this data every day on my social media accounts, so do connect with me for daily data updated late at night. Now friends, I come to the lift, weight, thrust, drag indicator. You won't get this anywhere on the internet in the public domain. This is an exclusive indicator. You've trusted it for almost 4 years now. Now take a look at what it's saying. It's crashed. In a very, very short description, it's crashed. It's at the lowest point in multiple quarters that I have started plotting this indicator since 2021. I have yet to see this steep decline of this magnitude, and that tells me that buying support at higher levels is likely to be very, very feeble. Sure, there will be short covering. Short covering might just stop your declines temporarily and it might even result in the price going up. But if you want a new high, if you want a bull market, hey, price and LWTD must go up together. Friends, my indicator is done. I now come to the bond market and this is the crux of my study, cost of funds. Do remember that in my money control column, in my live mint column, which is India's first media column to share statistical inputs with his readers, it's a free to read column. I have been warning you that cost of funds is going to rise and it should rise. Interest costs must go up. If at all, there is going to be a healthy investment scenario all over the world. I'm not just talking about India, I'm talking of the universe. Just look at how the Indian 10-year benchmark bond yield is basically meandering around at these levels. I've been telling you since the last 3 months minimum. And there is a video, especially after the Honorable RBI Governor announced his last monetary policy. You must watch that video and apprise yourself. There are actually 2 of them. Do watch both of these. I told you that I expect interest rates to go up. At least if they don't go up, I don't expect them to fall much. Check writers otherwise will not write checks and there could be liquidity issues. Are you aware that HDFC Bank last week has increased its interest rates yet again? Yes, they are offering a higher rate because they want check writers to give them more money. The government of India has raised interest rates on FCNRB accounts, wanting the NRIs to write out bigger checks in dollars so as to get more money. If somebody is telling you that interest rates are going to come down very, very sharply, I would say all the best to you. I reserve the right to go wrong. I'm human, but the weight of evidence does not seem to say that. So, as cost of funds go up, financial asset prices will come down. Do remember, financial asset prices are good to hold if they are rising faster than cost of funds. Now, it's like buying a very high risk product. Okay, you buy it on EMIs and suddenly your EMIs go up because interest rates went up. You calculate after 3 years or 4 years or 5 years of paying EMI with the interest, my acquisition cost of this product is going to be 6 lakh rupees. The ticket size of that product is 4 lakhs, 2 lakhs is interest. And after 2 years of use, this product is going to depreciate. For example, a car, and I will hardly get 1.5 lakh rupees for it. What do many people do? They stop paying EMIs, they default. They let the bank take the car off. This happens very, very commonly in the Western nations, and this is why the cost of funds concept is important. Friends, the bond market is done. I now come to the bank Nifty, and as the daily chart on your screen shows, this index has fallen very, very sharply. As a matter of fact, it fell 4.42% in the spot. It fell on all of 4 out of 5 days last week, and Friday was a slam dunk day. The price is very clearly below its month-long moving average, which itself is pointed lower. And look at the irregular head and shoulder formation. The price is staying below the neckline with a very clear and a noticeable margin. And if things get worse, if push comes to shove in the coming few weeks, I'm not talking of the week ahead, I'm talking of coming few weeks, the low made on 4th of June 2024 may just be tested again. Now, the short-term outlook, therefore, is nervous for now. Now, let's switch to the weekly chart, which shows a fall below the bullish trend line, which is not a short-term trend line. It spans over 32 months, 2.5 years. Now, when a 2.5-year-old trend line is broken, people sit up in their chair and take notice. Do remember, your cost of carry, your cost of funds are basically increasing your acquisition cost of your index, whether you're in futures, and the carry cost or the cost of funds will be much, much smaller in the case of ETFs. You would have obviously paid for the entire delivery, so there'll be no carry cost. But hey, interest is a realistic cost. So if the price is not able to beat the cost of funds and or cost of carry, the index is likely to fall, which is precisely what's happening, which is why you have broken a trend line of 32-month duration. The price is also below its 25-week moving average, which is a proxy for a 6-month long holding on cost of an average trader, which means the medium-term outlook is also nervous as of now. Now, do remember the rolling returns, cost of carry plus cost of fund, negative. Last week, I shared that chart with you. It's even more worse this week. Now, can a pre-budget rally occur? Yes, it might. There is an off chance that it might occur. But I see nervousness in the data. As a matter of fact, if you ask me, the TST and the churn ratio actually not just suggest nervousness, but they suggest fear. There was naked fear on many, many counters, especially interest rate sensitives. So numbers talk to a trader, provided you understand the language of numbers, which is what I've been preparing you for many, many months. Watch the interest rate sensitive stocks. This is where the selling is occurring the most on upsides. Now, friends, in the week before last, this index was number 6 on the most volatile counters list based on statistical beta ranking I maintain in-house. It jumped 4 notches to number 2. Bang! When a big index like this jumps in volatility ranking, challenge levels for the retail trader goes up. Now, last week, I advocated an estimated range between 52,700 on the upside and 49,275 on the downside. But due to the sheer volatility, it was violated on the downside, and the low it made was on 48,631. Ouch, I went wrong. Now in the coming week, the estimated range is between 50,450 on the upside and 47,025 on the downside. In addition to this range, please also monitor the daily, weekly, and monthly pivots that I share free on my Telegram channel and other social media accounts. Prioritize my Telegram channel first, foremost, and always. And also watch this video, which is a tutorial on how you can make more money by using our pivot tables. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell 2.39%. And exactly like the Bank Nifty before it, the Nifty also fell on 4 out of 5 trading sessions, as the daily chart on your screen tells you. The price is below its month-long moving average, which itself is falling, and the neckline of the head and shoulder remains a firm resistance area for now. Now, if push comes to shove in a worst case scenario in the coming weeks, remember weeks, you may see a level of 21,675 on the Nifty in the spot segment, like I said, in the worst case scenario. The short-term outlook, therefore, is negative as of now. Things can improve, however, if bulls keep the Nifty above the 24,250 mark for every single day of the coming week. Then I would grant them a benefit of the doubt. Now let's switch to the weekly chart. It shows exhaustion, fatigue, as the price is remaining below its 25-week exponential moving average, which translates to 6 months holding on cost, which itself is headed lower. Now, the rolling return chart of last week, which I shared with you, is even more horrible now. So, bulls are actually under pressure. A, they have mark-to-market payouts. B, the cost of funds and cost of carry is killing them. So, that's eating into the flesh and blood and bone of a retail guy. The fall has been on a very large, prominent, bigger candle, just like the Bank Nifty's fall was on a big candle, which shows range expansion. Now, that is not exactly a good sign. The prices are falling like a hot knife goes through butter. Equilibrium is therefore on the downside, which will show up on the snapshot window of your trading terminal. The medium-term outlook is therefore nervous as of now, and bulls are eagerly awaiting for any pre-budget rally for a chance to exit on their long positions which are stuck in the negative. Now, in the week before last, this index was number 12 on the most volatile counters list as per statistical beta rankings I maintain in-house. It fell 6 notches to number 18. Now, hold on, don't get out the bottle of champagne yet. I'm not saying that volatility of the Nifty 50 fell. The volatility of the Nifty 50 appears to be relatively lower because individual stock volatility went up much more faster than the Nifty 50. The Nifty has also got more volatile. So it's actually still a challenge. Now, last week I advocated an estimated range between 24,725 on the upside and 23,300 on the downside. I am relieved to tell you that this level held perfectly well because the low was 23,344. I just got saved by 44 points here. In the coming week, I estimate a range between 24,150 on the upside and 22,725 on the downside. Now here again, watch out for the daily, weekly and monthly pivots I share with you on our social media accounts. Also, the tutorial video on how to make the best of our pivot tables. Friends, I now come to the last bit of statistical analysis wherein I analyze the retail risk appetite in the 4 derivative segments, and here comes the weekly chart on your screen. Index futures contribution went up by 2 basis points indicated as a blue line. Stock futures turnover contribution went up 10 basis points indicated as a red line. Index options, the lowest risk segment here, a turnover contribution fell by 81 basis points indicated as a green line, and stock options turnover contribution went up 68 basis points indicated as a purple line. Net, friends, I would say that risk appetite was higher, but it was more from the HNI guys. Do remember that this daily summation that I share with you post-market, late in the night, sometimes early in the morning, has been indicating that the high net worth individuals, institutions, smart money, call it what you want, has been hammering stocks. Now, these are our proprietary indicators I've shared with you, and I'm trying to keep you up to date with as many of our in-house research data points as far as possible. Now, friends, I come to my own trading strategy in the week ahead. Hey, there's going to be no change whatsoever. Now, theta decay on interest rate sensitives will continue as a very viable, and I'm very happy with this game plan of mine, which I have been following for months. Public sector units are still the apple of my eye. This video here will tell you why I favor public sector unit stocks, because they are a lot more cleaner in their price discovery mechanism. Do watch that tutorial video. You will get to know what I mean. I'm not saying that long only. I'm saying two-way, long and short. These guys are making big moves, and this is what a trader wants. Oil and gas are moving seasonally, but the rally remains on shaky legs. This is a seasonal rally. It's not a secular bull market out here. Bullion is on a strong wicket, and I remain optimistic for the year 2025 and even beyond. I think bullion will continue to rise even after 2025, and which is why I've been telling you for many, many months in these videos, you should be allocating to bullion investments very, very liberally. In some of my videos, I have gone to the extent of saying 25, 30, even 35, 40% of your allocation to bullion. Metal stocks may see some upsides because Trump's inauguration is approaching, and there are hopes of a Trump reflationary rally as we saw in 2017. But I still don't subscribe to a super cycle theory here, and the robust jobs and economic data in the USA with firm oil prices has raised inflationary concerns, and therefore expectations of very liberal rate cuts are now receding, are falling. So if rates are not going to get cut, if cost of funds are going to remain elevated, are you surprised? Which is why volatility will remain in risk-on assets. So bulls are going to be nervous because inflation fears are higher, and that nervousness has been showing on the tick-by-tick data of the Nifty 50 futures that I have been uploading on my Telegram channel. Friends, this is the only platform that allows me to upload any kind of file format. Excel, PDF, pictures, graphics, zip, RAR archives, etc. So do connect with me there, and do download the tick-by-tick data of any traded security that you are focused on, and analyze it before you go to bed, before you say your prayers, you brush your teeth and hit the sack. Before you fall asleep, this is a must till the budget is out. Friends, so far all my expectations of pro-cyclical hysteresis are coming out true. We are on the ball, we are on time, on target. I told you 2025 would see the onset of pro-cyclicality, and here you are. Negative outcomes come when the mind is not prepared, when the mind is surprised. But you and me do not enjoy the luxury of claiming that we are surprised. We knew. What stops you from going out there and claiming your place under the sun? Friends, with this cheerful thought, if there are any more ideas that I need to share, I assure you I'll be sharing on my social media accounts. Do connect with me there. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know what you think about my work and what you would want me to record next. Also, please help me by spreading the word of knowledge-based investments and trading by sharing my videos with as many people, as many groups as you can. Also, thank you for helping me out last week in getting our accounts restored. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a profitable week ahead. Take care. Bye-bye.